So again, my name is Scott White. I'm a financial advisor and sit on the investment committee at Bloom Advisors. And I've been with them about 22 years, spent another 10 years at Charles Schwab, where I was a vice president and branch manager. So this is pretty much what I've been doing my entire adult life. So hopefully I bring some knowledge to the table tonight. And, as far as the size of our firm, Bloom Advisors, we manage about $1.4 billion, which, believe it or not, is, small to medium size, money management firm. There's some firms that are a lot bigger than us, and there's some in the area that are smaller as well. So topics to cover today, really just kind of broadly mention these, is that, to me, the very first stop when you're thinking about what to do in a down market is reviewing your long-term financial plan. And then we've got some smart money moves, which I'm going to go through each one of these, in a little bit more detail in a moment. But increasing contributions to investments is a good one. Reviewing your emergency fund, rebalancing your portfolio, harvesting tax losses, which you may or may not know what that is. We'll get into that, explain it in more detail. And then, of course, Roth conversions, are a possibility, and definitely have some other things as far as, just what to do if you don't feel you've done enough during a down market. And then, again, we'll have the Q&A at the end. And we're definitely in a down market. So I just wanted to kind of mention that briefly, that the S&P 500, which is the broadest measure that most people look at for U.S. stocks this year, it's down about 17%. Year to date, which is a pretty rough year. International stocks are down about 21.5%. And bonds, as measured by the Bloomberg Barclays Aggregate Bond Index, are down 12.5%. Bonds are actually having the worst year they've had in about 100 years. And so it doesn't really get any worse than this year, as far as there's not really a safe place to hide. And that can make people, anxious about their portfolio and their plans for sure. So first off, just like to say is that if you have an advisor and you haven't reached out to them for guidance this year, it's probably a good time to do that. Advisors like us can be a steadying hand. I tend to tell folks that, basically you pay us to manage your money, but really where we earn our keep is keeping clients from making mistakes, like cashing out of the market or things of that nature, which can be very damaging over the long run. So if you're handling your finances on your own, though, you should really focus on these couple of questions, which is, does the market volatility affect your goals? So the fact that the market's down, 17% broadly, 20% globally, does that really affect most investors' goals? It shouldn't, if you're a long-term investor, but it may, depending on how your portfolio is set up and what your goals are. And then the other question to look at is, does my current portfolio still allow me to achieve my goals? And here again, it gets back to an appropriateness. Is the answer should be to that yes for most investors. In other words, your portfolio is set up in such a way that just because the market has declined, it hasn't thrown you off track from being able to achieve your goals. It's one of the things that we focus on all the time with our clients, is that we want to make sure that whether it's savings goals, in other words, accumulating what you need to accumulate by the time you want to retire, or income goals, drawing income from the portfolio in retirement, that there's room and leeway for down markets because they happen. In fact, probably most people remember that March 2020, at the beginning of COVID, markets dropped substantially over a period of like 3 weeks. It was much more significant decline than we've experienced this year. It was about 35%, all in 3 weeks. But then within a few months, it had recouped. And by the end of 2020, stocks were up like 20%. And so people kind of forget about it. But it's normal to have down markets. Generally, you'll see, kind of a bear market like we're experiencing right now, stocks down roughly 20%, about every 5 years. And so whether you're a pre-retiree investor or an investor that's in retirement, you need to know that this is just part of the process. Sorry about that. I clicked that a little bit ahead of goals, and it's just going to happen from time to time. And for the most part, a down market shouldn't impact your plans, other than that, hey, you feel bad that, things are down, statements don't look good, portfolio values don't look good. And then, the other question to ask really is, will changes to my plan, if any, have tax consequences? And so for some investors, I find this is fairly common. Some investors, if they make a change to their plan, there's zero tax consequences. Now, when does that happen? That typically happens if you're, solely a 401k investor or 403b. So in other words, a company retirement plan. Mm-hmm. Those retirement plans are tax deferred, and any transactions, buys, sells, are just all sheltered. So the unfortunate downside is when you're losing money in your 401k, you can't, take a tax loss and deduct it off your taxes. But on the flip side, if you said right now, well, I want to throttle down my risk and I want to sell some of my stocks, and they have gains on it, well, the upside is that you're not going to pay tax on any of those gains because it's just deferred within the retirement account. So for this last question, where this is really going to impact you, is more if you have non-retirement account investments. So investments that are just, individual stocks, individual mutual funds, but how they're registered. Are they held in your individual name, joint name, maybe a trust registration? Those are the three most common account types that are exposed to taxes 100% of the time. So any move you make, get a dividend, get a capital gain distribution, do a buy, do a sell, that's all exposed to taxes. So if you are making changes and you have a non-retirement account, then that's an extra consideration. So what can you do to minimize them? Well, if you've got some other tax losses that have maybe accumulated, hopefully you can kind of pair those off. And we'll talk about that a little bit later on in the seminar as well. So big picture, start off with that long-term financial goal plan. Are you on track, and does the downturn change it? Probably not. So some of the smart money moves you can make, we've got 5 major opportunities, and we'll kind of go through each one of these one by one and delve into a little bit of detail on each. So my favorite one is increasing contributions to your investments. So, sometimes I get, questions from our clients or just investors in general saying, well, the market's down. Should I stop contributing to my 401k? As an example. And that's exactly the opposite of what you should do. What you should do is keep on contributing to the 401k. Those systematic automatic investments are really the best way that you can build wealth over time. And if anything, if you can increase your contributions during a downswing in the market, it's really a way that you can take advantage of what right now, at least, is an unpleasant situation. And I tell my kids this, who are all in their 20s, is that, when they think about investing for themselves, that, you shouldn't really focus on the short term, you focus on the long term. And being that they're as young as they are, down markets really don't matter. If you're contributing to your 401k, you just keep at it. And knowing that eventually over a longer period of time, markets will recover. And the benefit, though, of doing that is kind of what we talk about as dollar cost averaging. So, if you're investing money over a period of time in a declining market, you may see a scenario like this, where, say, you're investing $100 a month. At the beginning of the year, you were investing into a stock or a fund, and its price was $10 a share. So that first purchase of the year, you only bought 10 shares. But over the next couple of months, share prices declined. So they went down to $7.70 a share and then $6.25. So pretty significant. That's actually a little bit more significant of a sell-off than we've seen this year. But when you continue to systematically invest that $100 a month, in month 2, you're buying 3 more shares. You're buying 13 shares. In month 3, you're buying 16 shares, so 6 more shares. And then in month 4, and I kind of did this just because it works out well for the numbers, but we've got sort of a recovery month. So you're not back up to 10, but things have recovered back to $8.33. So you bought 12 shares that month. And what happens is, if no decline had occurred in the market, over 4 months, you'd invest your $400, you'd have 40 shares. Instead, what's happened here is you've still invested the $400, but now you've got 51 shares because of the decline in price. Your average price per share is only $7.84. And because things have kind of come back up a little bit in the last month, instead of having your original $400, even though the market's declined so far during this example, you're actually at $408. So you made $8 on your investment. And you'll find that over long periods of times, that's really the benefit of systematic investing, which again, most people do through 401ks. So I would tell you that, if you haven't looked at what you're contributing, and I know it's not always easy, but this is a good time to look at it and see if you can squeeze maybe an extra % or two out of your budget into contributions into a plan like that. And talking a little bit about just what are those contribution limits for these plans. So again, you want to make sure that when it comes to 401ks or 403bs, those company retirement plans, the very first thing you want to do is make sure you're contributing enough to at least get 100% of the company match. So a lot of companies will do this kind of thing where if you invest 5% of your money, they'll match dollar for dollar on the first 5%, or they might have a formula that says, okay, on the first 5% of your salary that you invest, we match dollar for dollar. On the next 3%, we'll match 50 cents on the dollar. So what you want to do when it comes to these plans is make sure that at a bare minimum, you're contributing enough to get that full formula match. So you're going to get every penny. Otherwise, you're just leaving free money on the table. And, your employer isn't necessarily going to thank you for not doing it, although it benefits them because they're not having to kick in as much as they otherwise would have. The contribution limits, though, once you, get beyond that bare minimum to get the company match, there are some upside limits. So with a 401k and 403b, all the major type of plans, you can't contribute more than $20,500 per year. For older folks like myself, over 50, you can contribute an extra $6,500. So for a total of $27,000 a year. And the second most popular account that I really see investors putting money aside into is either a traditional IRA or a Roth IRA. And just the differences between those real quick. A traditional IRA, when you put money in, many times you get a tax deduction, but not always. So if you're contributing into a 401k, you won't get a deduction, generally speaking, for money you put into an IRA. If you don't have a company plan, that's typically where you can get a tax deduction for that traditional IRA. And then that money is growing tax deferred with the goal of not being withdrawn or taken out until after age 59 and a half, when you get in that sort of retirement zone. The Roth IRA is different in that you never get a deduction for putting money into a Roth IRA. However, that money grows tax-free for the rest of the time the money's in the account, even into retirement. So the payoff is really great for younger people, but even people in their 40s, 50s, 60s that are still working. They put money in, it's growing tax-free for the future, and that's great. Here again, you got a $6,000 limit for the IRA. For older investors, they can kick in another $1,000 for a total of $7,000. And then a couple of less frequently seen plans, but I figured I'd mention them just in case, is simple plans, usually set up by small businesses. You can put in $14,000 and an additional $3,000 for those over 50. And SEP IRAs are kind of unique. Those oftentimes are used by self-employed individuals. So they have a very high contribution limit of $61,000, but that can be, it basically has to scale up, can be no more than 25% of your gross income. So you have to really be a high income earner to max that out. But what's interesting about the SEP, there's no catch up for those over 50. So that's definitely kind of a different account. And if you're able to max out your tax deferred accounts, the retirement accounts, then you should consider investing in a non-retirement account, which again would be something that is individual name, joint name, living trust name, that type of account. And that's money that you can easily access before 59 and a half. You can really dip into it at any time. But with those non-retirement accounts, again, anything you do does have tax implications. So even dividends that you receive. So again, that's my favorite, increasing contributions, leaning into the down market by adding more when it's down. Never think that you're throwing good money after bad, because ultimately every stock market decline recovers over time. You can go back 100 years. There's never been a period of time where stock markets don't recover. Sometimes they recover in a year, sometimes 2 or 3, sometimes takes a little bit longer, but they always recover. So adding when markets are down as opposed to stopping is the right, the smart money move. So reviewing your emergency fund, and now I think this is one that's kind of a quick topic to talk about, but it's important because emergency funds have definitely changed as far as the sexiness factor, in that, you know, rates have jumped up, and so now things that you might traditionally put money into for an emergency fund, they're actually now paying a reasonable rate instead of zero. So when you think about an emergency fund, anybody who's working should have an emergency fund equal to about 6 months worth of their expenses. This is really to protect against the possibility of unexpected job loss. And so right now, you might say, well, Scott, gosh, unemployment's at, you know, practically 3%, and, you know, we're creating 200,000 new jobs a month. That, aren't we in a pretty robust job market? Well, it's true, we are. But the reality is we never know when the job market is going to loosen up. And what the Fed is doing right now, as far as raising short-term rates to try and tamp down inflation, over the long run, typically that does have a negative impact on the economy and eventually jobs. And so you want to make sure that if your emergency fund is low, now is the time to beef it up. And, you know, in fact, I would tell you, if you don't have 6 months in your emergency fund, as opposed to increasing your investments into the market, you should really shore up that emergency fund first. Now, on the flip side, and I run into this quite a bit, if your emergency fund has exceeded the 6-month target, in other words, you're sitting back and you're saying, Scott, wait a second, I don't want to be throwing money at the market, so I've just been letting it accumulate in my checking account. So now instead of 6 months worth of emergency fund, I've got a year's worth. Or, you know, I've run into this a couple times recently, where I actually had a client tell me that they had 2 years worth of their expenses just sitting in cash. And, you know, my advice to them, and I would make the same advice to you, is now is a great time to take that excess money that exceeds your emergency fund and put it to work in the market. So even though, you know, emergency fund rates look better than they did, you know, just 6-7 months ago, it's still, you want to buy in when things are cheap and participate in the recovery, which eventually will happen. So what type of accounts or investments should you consider for an emergency fund? So the number one goal in my book is you never want to put your principal at risk of fluctuating in value, so that when you dip into it, what you originally put in isn't there. You want to avoid that at all costs. But there's a trade-off between return and risk. So when safety of principal is your top priority, generally you're going to get a fairly low rate. So interestingly enough, if you looked at savings accounts literally as little as 7 months ago, 8 months ago, so you look back to the end of last year, you'd find that savings accounts were paying about 0.1 or 0.2%. Now, recently, because the Fed's been raising rates, they've actually raised rates 2.25% this year on the short term. Money market rates and savings accounts rates are all coming up with that. And it's fairly easy to get a rate on a very safe money market fund or savings account. And again, the savings accounts are FDIC insured, that's paying you more than 2%. In fact, I'm going to bounce over to my browser real quick here. I had pulled up bankrate.com. I'm not going to share this with you guys because it's a little bit too much back and forth. I don't want to screw that up, but I'm just going to pull it up. And the savings rates, so locally, as I said, bank rates, looking at rates across the entire country. And they actually have a bank, which I've never heard of, but they're FDIC insured, UFB Direct, paying 2.61%. Now, there's other banks in here that I'm very familiar with, like Citizens or Synchrony, and they're paying rates at like 2.35 or 2.15. So there's definitely opportunities to get a great rate on your emergency fund without taking a lot of risk, which you shouldn't be doing. Like, what you shouldn't do for that emergency fund is to be saying, well, you know, someone told me AT&T is paying 6%, so shouldn't I put, you know, my emergency fund in AT&T? Well, no, because AT&T can drop 20% in value, and then that offsets the 6%, and then you're down another 14. So you don't want to be putting emergency funds into stocks or cryptocurrency or anything like that. So a couple other areas that can work for an emergency fund: certificates of deposit, as long as they're short enough. Because remember, with a certificate of deposit, typically you can't cash out early. So if you're going to use something like that, you want to look at, you know, probably a 3-month CD. And then the other alternative, you know, and this could be more for emergency funds that are, you know, closer to that top end of the 6-month limit for you is I bonds. So I bonds are paying 9.62% right now. It's an incredible rate because inflation's high and I bonds are pegged to those. But what you got to keep in mind is that I bonds are meant as a 5-year investment. And you have to keep the money in there at least 1 year before you can actually cash out. And so if I were trying to use I bonds for my emergency fund, I'd probably want to look at it as, well, yeah, Scott said 6 months, but I want to have 9 months or a year in my emergency fund. Well, for that amount that's beyond 6 months, yeah, you could put that into the I bonds. But for your first 6 months of emergency fund, it really shouldn't go beyond savings account or a money market. And rebalancing the portfolio. So we've got a couple of slides on this, really important topic. So rebalancing is critical during volatile markets. What this does, and we do this for our clients, we do quarterly rebalancing, but it really provides a disciplined way to buy low and sell high. And rebalancing allows you to take advantage of short-term declines in the market that I have no doubt will benefit you long-term. The process also ensures that your portfolio stays in line with the amount of risk that you're willing to take. So say for an example, talking about just broad asset allocation. So why can rebalancing work? Well, it can work if you have a diversified portfolio. So our basic approach to asset allocation is that we believe all investors should have a globally diversified portfolio. Now, what that means is that there should be a combination of U.S. stocks, international stocks, and bonds in the portfolio. And the exact allocation depends on the amount of risk that you want to take. Someone who's more conservative might be looking broadly at, 55% stock portfolio, 45% bond. Someone who's willing to take moderate risk would have more in stocks, 70% stocks, 30% bonds. And then that aggressive investor, at least in our view, would probably be targeting more 85% stock and only 15% in bonds. So bonds provide that cushion in a down market, which is why the more conservative you want to be, the more you'd have in bonds. And even though bonds have lost significantly, as I mentioned early on, they've had the worst year they've had in 100 years, bonds have still lost less than stocks have lost in 2022. So, but big picture, more stocks, more aggressive, less stock, less aggressive. And so what happens as markets gyrate, though, is in the broad picture, you're going to find this happening, is that if your target allocation is 60-40, so 60% stocks, 40% bonds, and then the markets drop, well, your portfolio automatically becomes more conservative on its own. In other words, stocks have dropped, and now they're only 50% of your portfolio. And even though bonds have dropped, they've become a larger portion of your portfolio, up to 50%, because they haven't dropped as much as stocks have. So when you rebalance, what you're really looking to do is get back to this original target, the 60-40. And what I find oftentimes happens when I'm reviewing our client portfolios and making adjustments to it is we're typically selling from bonds right now during 2022, and we're harvesting some losses, which we'll talk about in a bit. And we're taking those bond proceeds, and then we're adding to international stocks and U.S. stocks. And typically, we're adding a little bit more to international stocks because they've declined a bit more than U.S. stocks. And we're adding the least amount to U.S. stocks because they have not declined as much as international. And, within the U.S. space, small caps tend to be the worst performers along with U.S. large cap growth. So when we look at our U.S. component, we like to have growth, value, and blend. But yeah, the growth area has definitely been, hit the hardest. So when I look at U.S. stocks and adding to it, typically that's what I'm doing is I'm replenishing to the U.S. large growth because that's the area that has dropped the most, and maybe a little bit to the U.S. small cap. And then with international, similarly, I tend to be adding to emerging markets because that's been the hardest hit area in the international, and then foreign large growth because that's the area that's been hit the second hardest. And again, this might sound counterintuitive. So in other words, why do we add to the areas that have gone down the most? And my answer to that is exactly. That's the beauty of rebalancing, is you add to the things that have gone down the most. As Rick Bloom, of one of the founders of our firm, is often fond of saying, is you want to buy things when they're on sale. And that's exactly what you do. So rebalancing is just that disciplined approach to force you to, buy stocks when they've dropped and take from bonds which have held up better in value. And there's periods of time where it's the reverse, like in 2020 and 2021, it was generally kind of the reverse of what we just talked about. So those were 2 years over the last couple where stocks were performing well, and the shift was the other way. So over a period of time throughout the year, stocks became overweight relative to our targets and bonds became underweight. So what did we do? We sold a portion of the stock funds, take some of those profits off the table, and then we reinvested into the safer bond funds. And what that did is it set up us well for 2022. So we didn't let things get way out of control. And then when the stocks dropped significantly in 2022, the portfolio gets destroyed. We really said, no, we're systematically taking our profits. We're getting into some of these safer bond areas. And again, even though bonds have declined, they've held up and portfolio values are better today than they were, 3 years ago by a significant portion, even though the portfolios have generally dropped, a good 15, 16% this year. So harvesting tax losses. So this is one of the things that generally you can only do in a down market. So it's a real smart money move to make in times like we're going through right now. So tax loss harvesting is a strategy that many investors use to reduce their taxes by selling investments that have dropped in value. But you avoid locking in those losses by reinvesting into a similar investment that allows you to rebound and recoup those losses when that particular area of the market recovers. So remember how I was just talking about U.S. large growth being one of the hardest hit areas this year. So that's oftentimes what we're doing. We're tax loss harvesting by selling a model fund that we like in that area, but then we're buying a very similar other model fund that we like in that same exact area. So we're not running from U.S. large growth. In fact, what tends to happen is we take the tax loss, we take some of the money from the bonds, add it to the proceeds from the tax loss, and then buy that very similar investment in that same asset class. So if you're selling a small cap fund at a loss, you want to buy another similar small cap fund. If you're selling if you're selling a municipal bond fund at a loss, you want to buy another municipal bond fund or a corporate bond, that's at a loss. You want to buy another corporate bond fund, and like investments, but not identical. So, and typically there's one of two ways to do it. So if you want to make the tax loss harvest immediately, which is what we typically do, we sell the investment and the very same day swap into that alternative. That way you're staying in the market. You don't have to worry about the volatility. The other way that you could harvest tax losses is you could sell and wait 30 days and then buy that same investment back. Now, the reason you'd need to wait the 30 days is if you if you sell at a loss and then repurchase that same investment within 30 days, it's a wash sale, which means you can't even deduct the loss. So that kind of null and voids it. So that's why buying a similar investment with your tax loss proceeds is a way to do it and remain in the market so that you're not out. Because remaining in the market is really the best way to, capitalize on a rough market that we're going through. You don't want to be sitting on the sideline because the biggest gains tend to happen when markets turn around. And what if that's in your 30-day window? So once you've harvested those losses, you can only deduct $3,000 from your ordinary income taxes per year. However, you can use an unlimited amount of those harvested losses to offset other capital gains that you may have or capital gains distributions. And so one of the interesting things about mutual fund investing, or even exchange traded funds are another popular tool that people use, is that those funds are required to pay out 90% of the gains that they realize when they make sales throughout the year. And so when you have a mutual fund portfolio in a non-tax sheltered account, you're going to find that every December, you're getting a certain amount of capital gains distributions, 2, 3, maybe even 4% of the value of your portfolio is paid out. And even though most people just reinvest those capital gains distributions, you owe tax on the fact that the capital gain was paid to you, even though it was reinvested. Now, if you just flat out sell an investment and take a gain, so that's another situation where you're going to pay taxes. So these harvested losses can be used to offset either one of those categories fully. And then if you still have losses left over, you can take $3,000 off your ordinary income taxes. And then any leftover losses can be carried forward into future tax years. So I like to show a couple of examples of how this works, though. So first example is John sells an investment with a $5,000 gain. So, he bought Tesla a number of years ago and it's gone up significantly. He says, yeah, I'm not so sure about Tesla anymore, so I'm going to sell some of it or all of it. Boom, I got a $5,000 gain. However, he doesn't want to pay taxes on that gain, or at least he wants to minimize it. So what he does is he takes a look at his portfolio. He says, 2022 stocks are down. I'm going to sell one of my investments that has a loss that's down $4,000 from my original purchase price. What John can do is he can then net out the two. And so now instead of having a $5,000 gain for tax purposes, he's only got a $1,000 gain for tax purposes. And he's only paying taxes on $1,000 capital gains for the year. Because he didn't have more losses than gains, he's got no tax carry forward. Now, the second example is something I see fairly frequently, is that, Sally sells the investments this year with losses that add up to $10,000, but she doesn't sell any investments with gains this year. Not that she doesn't have investments with gains, but she didn't really want to sell any of those investments. So let's just say she owns Tesla as well, and she says, I'm not falling for John's trap. I think Tesla's a great company. I'm going to continue to own that, so I'm not going to sell it for a gain. So what she can do is deduct $3,000 of those losses from her ordinary income for the 2022 tax year. Then the remaining $7,000 can be carried forward to future tax years, where she basically repeats the process. She can use the losses carried forward to offset capital gains or capital gains distributions, or yet again deduct $3,000. So if she doesn't really have other gains, she could end up, using this capital loss for 3+ years before she whittles her way that $10,000. But the cool thing is tax loss carry forwards, for an individual, they never expire. So you can always find, that there's an opportunity to use them. And so Doug R had asked a question, and that's so funny. So really just hit that one right on. I'm going to say that I answered that live. Doug's question was, how many years can you carry losses forward? And yeah, it's indefinite. So the interesting thing though is corporations do have a limit, which I believe is closer to like 5 years as far as how long they can carry forward. But for us individuals, it's an unlimited amount of time to carry them forward. So take advantage of tax losses, harvest them to the dickens as much as you can, and use them for future years. And I find that's what we're tending to do. So, with clients that we manage, no one likes losing money, but that's always the silver lining that I tell people in a year like this year is, hey, rest assured that we're going to harvest tax losses. And so for 2022, in all likelihood, most clients aren't going to have much of a tax ramification at all. And I might have enough tax loss carry forward to offset gains for another year or two. So things, even though there's a decline, it really does help the tax situation. So the other big topic, and is really converting your IRA to a Roth IRA. And but I got to say though that this is not for everybody. So I did talk earlier about the difference between a Roth IRA and a traditional IRA, but it's important to keep in mind traditional IRAs are just tax deferred. The Roth IRA is one that you basically is going to grow tax free. And so that's why you consider doing it. And, the issue, with it is now a good time. Well, or really, why is now a good time? So when the markets are down, the amount in your IRA has likely dropped in value, unless you're just really just sitting on the sidelines. So if you were to convert money from a traditional IRA, the tax on the Roth conversion would be smaller than when the IRA was at a higher value. And keep in mind that when you convert money from a traditional to a Roth IRA, you don't have to convert the entire IRA. You can do a portion, but whatever amount you do convert, ultimately, you're going to pay ordinary income tax. So as an example, if you have $100,000 in an IRA and you convert $10,000 from the traditional to the Roth IRA, so just a partial conversion, that $10,000 adds on to your tax liability for the current year. And importantly, which I'm going to talk about on the next page, you need to have money to pay those taxes if you're going to consider a Roth conversion at all. So here are the important questions to me that people should be looking at, some considerations of whether a Roth IRA conversion may be beneficial. So number one, and this is to me the most important, is that you expect to be in the same or higher tax bracket in retirement than you are now. So if you look at things and expect to be in a lower bracket in retirement, a Roth conversion is really not as beneficial, as you'll be converting while you're in a high bracket now. So both doing two things, paying in a higher bracket on that conversion and speeding up the taxation to now. So you're trading that for a future benefit of avoiding taxes on the growth when you'll be in a lower bracket. And ultimately, that still might work for some folks, but you tend to need to lengthen out your time of investment for it to be possible. But my general rule of thumb is same or higher bracket, fine. If you're expecting to be in a lower bracket in retirement, don't do it. Or wait until you're in retirement and then maybe consider doing the conversion at then. And don't worry about the fact that we're in a down market. So that's what you tried to do. So the other couple other considerations is you really want to be able to let the money that you convert grow for at least 10 years before dipping into it. If you don't have that 10-year time frame, again, I would generally skip that Roth conversion. But most investors do have 10 years to let the money compound, so that even if you were to in retirement convert, I tend to find is that the order of spending tends to be non-retirement accounts first, then IRAs second, and then Roth IRAs last. So in other words, you want to let those Roth IRAs compound as long as humanly possible. So that's the money that you're going to dip into last. Well, most retirements are going to last longer than 10 years. And if you're pre-retirement, you've definitely got more than 10 years. So for most people, that time frame conversion matters. And then the third major consideration is you can pay tax on the conversion without dipping into your IRA account. So you've got to have money on hand to cover that tax burden, which, if you're oftentimes a typical person living here in Metro Detroit, you're in the 22% federal bracket if you're working. It's certainly if you're blue collar, maybe you're in the 12% bracket, but I find most couples these days, even blue collar couples that are both working, you're in the 22% bracket. That's federal. And then state's another 4.25%. So that $10,000 conversion is going to cost you about $2,700 in taxes that is due, pretty much this year. So the other kind of couple of wrinkles that might make you consider converting a portion of your IRA to a Roth that might be more situational is, say your income is lower this year than normal. And again, I find this tends to happen if you're just entering a retirement, or it could be maybe you're in a sales job, maybe you're a realtor, and the fact that rates have gone up to 6%, your turnover in homes has dropped to 0. So maybe your income is going to be lower this year than normal. And then if you've fallen into a lower bracket, it's going to make that Roth conversion more beneficial. The other thing that you could have is maybe you have a bunch of other losses or deductions that have lowered your income this year. But again, there's some limits to that. That's probably not going to have a huge impact, especially if it's losses from capital gains, which are limited to $3,000. So when you feel like you're not doing enough and you've already, taken a look at those 5 different areas, I would say a couple of things that you can always take some time out to do during a rough time in the market like we're going through is look at the basics, which everybody should have in place. Your budget, both now and in retirement. And by budget, I don't mean what you earn. Your gross income isn't your budget. I really mean sitting down and taking a look at what does it cost you to live? And hey, when I'm eventually retired, what does it cost me to live? Is my mortgage paid off? Am I no longer contributing to a 401k? So you want to be looking at your expenses and how that changes. So oftentimes when you don't want to look at, declining statement values, you kind of turn to these other areas and know that the time is still going to be well spent. And I do find with some of our clients, the biggest roadblock to, getting a gauge of are they going to be ready for retirement when they want to be ready for retirement is the lack of a budget. The fact that people really don't know what it costs them to live every month, and they have to first start off there. And then we can talk more about, okay, do we need to save more? Are you on good track, or so on? The other thing that's, I think, a good time to check into is just how does your estate plan sit? Have you sat down with an estate planning attorney? Have you put in place a trust if you need one, or at least at a bare minimum a will? Everybody should have at a bare minimum a will. And some of the other basic documents that come in that estate planning mix are medical power of attorney, durable power of attorney. Medical power just allows someone else to make, healthcare decisions on your behalf. Durable power of attorney comes into play, say, if you're incapacitated and you need someone else to make a decision on your behalf. And even a husband and wife, they need these things. So just because you're married doesn't mean that automatically your spouse has legal ability to make those decisions for you. And more and more, it becomes important with estate planning to have some record of what you own electronically and how to access things electronically. It's good to have lists of passwords kept as well, so that if God forbid something happens, your beneficiaries are going to be able to access these things, whether it's bank accounts, investment accounts. And lastly, lastly is beneficiary designations. So IRA accounts, Roth IRA accounts, 401k, 403b accounts, all of those are going to have beneficiaries, and you need to make sure that you've appointed the appropriate ones. Oftentimes with a married couple, it's going to be husband or wife as the primary, and then kids as the contingent. If you have minor kids, though, generally you don't want to make them the contingent beneficiaries until they're adults. And that's where that kind of loop back to the estate planning works, where you may, if you have minor children, you may want to look at a trust to make sure that things are going to be handled appropriately, and the kids just don't inherit a bunch of money at 18 if, God forbid, something happened to you while they were still young. And you'll find that even individual accounts and joint accounts, most brokerage accounts and banks have a way to add beneficiaries now. The law was changed a long time ago, more than 10 years ago, that allowed Michigan financial institutions to set up what they call transfer on death designation or beneficiary designations for those accounts that normally didn't have them. So that's kind of the bucket list of what I wanted to cover for smart money moves to make right now during down market. My final thoughts, I just want to talk a little bit about, kind of what do you need to do and what should you avoid doing? And this kind of leads to a question that I received from someone who's listening. And I will leave that nameless because my advice is going to be that you didn't do a good thing. So one of the questions I got is, I sell all my stocks when the yield curve gets inverted, like it is right now. I save thousands. Well, my argument or point would be is, you save thousands in the short term. The question is, when should I get back in? Well, my answer to that is, you never should have got out, because here's the problem. The likelihood of you getting in at a lower point than where you got out and you believed you saved yourself thousands, the likelihood of you getting back in is pretty much zero. In 30 years of doing this, I've never had a client that I've dealt with make this call correctly. And it's one of the reasons why at Bloom Advisors, we don't do this either. So we set up our portfolios knowing that there are going to be down markets. And even with an inverted yield curve, that's not a sell signal for us. We know that we've got a diversified portfolio. We know that we're going to take some losses in a year like this year, but we also know we're going to recover. And what that keeps us from doing is trying to find the right time to get back in. And I would say the person that asked the question, this is going to be your problem, is you're likely to get back in at a higher level and you're not going to have saved yourself thousands. And especially if the market turns quickly. As an example, tomorrow, the Fed is talking. They're going to tell you what they did as far as raising short-term rates, which might push the yield curve even more inverted, but maybe they won't. What if the Fed didn't raise rates tomorrow? Stocks are going to rally like crazy, and they're going to go up, 4, 5, 6% in a day. And that's why, in my mind, it's never a good idea to cash out of the market. You got to have a diversified portfolio that you can stick with through the downturns. Is that lots of studies show, and I didn't include a chart in this, I probably should for next time, but ultimately, over periods of 5 years, 10 years, 15 years, 20 years, 30 years, doesn't matter what time frame you look at, what you're going to find is that the biggest gains are made typically closely after the biggest losses. And so by the time you realize that the markets are going to turn around or you feel better about investing, it's already happened. The markets have already recouped 10% or sometimes 15%. I saw that happen in 2020. for investors that said, oh, nope, I can't take the COVID decline, I'm out. Well, they got back in 3, 4, 5, 6 months later, stocks were 30% higher. They locked in a permanent gain, even though at the time they thought they were saving themselves thousands by getting out, but they really didn't, because they ended up getting back in at higher prices. Saw the same thing back in 2008, 2009 when the global financial crisis happened. So in that, people panicked, they got out because, oh gosh, I've never seen stocks down 30%. They're just going to keep on going. Eventually I'm going to have zero. Well, that doesn't happen over the long run. When you stick with it, eventually you recover. So that's my answer to that one. And with that, eventually things are going to recover. Is it going to happen in 3 months or 6 months? We don't know the answer to that. None of the talking heads on CNBC know that. Jim Cramer doesn't know that. And your brother-in-law definitely doesn't know that. But what I do know is that people that are invested right now stay invested. 3 years down the road, they're going to be rewarded for it. 5 years down the road, they're going to be rewarded for it. Don't worry about the statement declining in value and thinking that you need to, avoid that loss. Build a diversified portfolio that can weather the ups and the downs. And so at this point, I'm going to open it up to questions. If you've got additional questions, go ahead and you can type them out in the chat or the Q&A, either way. And it's about almost 7:20. I plan on wrapping up by 7:30. So I figure I'll give it a minute or two for people to type out questions they have. And then if I don't see anything come in, we will wrap it up. But I definitely appreciate everybody attending, and thank you for the questions that we did get. And hopefully it was beneficial to you all.
Thanks, Scott. We can wait a couple minutes to see if anybody types any questions into the Q&A or chat box.
Great. And I would say this too, is that if you happen to think of something after the fact, you can always stop by our website, bloomadvisors.com, learn more about our services, but also under the bio area, you can click on my name and you can shoot me an email, and I'd be more than happy to answer a question that way as well.
Thank you.
Yeah, so great question. So what about fixed annuities? So it's one of those questions that I get a lot, because you'll find that fixed annuities are advertised a lot during down markets. So thank you for asking that question. So fixed annuities can be a good investment for very conservative investors, because they're basically like a certificate of deposit alternative, and you generally get tax deferral on it. But what you got to remember about fixed annuities is that they're paying you a fixed rate. So, maybe 3%, maybe 4% right now. You're never going to earn over a longer period of time what you can earn in the stock market by investing in fixed annuities. But what they tend to do is give people peace of mind that, well, they can't go down in value. And it's true, they can't. But when you buy a fixed annuity, you're typically locking the money up for 5 or 7 years, and you get the rate that they're paying now. Eventually, that rate can reset. So let's just say a year or two from now, inflation ebbs and rates go down. The rate on your fixed annuity is going to decline along with it, but you're not going to be able to get out of that fixed annuity without paying surrender charges. Because fixed annuities are an insurance contract and not a true, investment in stocks or bonds, it's really contractual. You got to read all the fine print. But you'll find that most of the time, if you get out early on in an annuity, you're going to pay several percentage points in surrender charges to get out. So a fixed annuity works for someone who wants to be conservative and is willing to accept a lower return for a longer period of time. So not always a bad investment, but we definitely don't use them in our approach to investing, because we feel there's better and more flexible ways to do it for just about any investor, even for the very conservative ones. Great. Well, thanks a lot, Karen, for inviting us out to speak. And again, to all those that attended, appreciate it very much for you showing up.
Oh, thank you so much for coming. You guys are great.
Thank you.
We really appreciate all the advice. And if anybody has any final questions, feel free to put them in the chat. You can always email us here at the library too. It's asref@troymi.gov.
Great.
Okay, thanks. Well, you have a great night.
Thanks a lot. You too. Good night.
Okay, bye-bye.